Something happened while you were sleeping that just changed everything for precious metals investors. Silver dropped hard. Gold shattered through a critical psychological barrier. And this all went down when half the planet's trading desks were completely dark. If you're holding physical metal right now, or you've been watching these markets, the next 72 hours are going to decide whether we're looking at a massive buying opportunity or the beginning of something much worse. Right now, silver is trading around $76 per ounce after falling more than 1% in a session where most major markets were completely closed. Gold broke below $5,000. And I know that number means something to a lot of you because we've been watching that level for weeks. But here's what nobody's talking about yet. This pullback happened on some of the thinnest trading volume we've seen in months. Chinese markets are shut down for Lunar New Year. South Korea is closed. The United States had a holiday. When liquidity dries up like this, prices can swing wildly on relatively small orders. And that's exactly what we're seeing. Before we go any further, if you're someone who wants straight analysis without the hype, without someone trying to sell you a course or tell you precious metals are going to the moon tomorrow, hit that subscribe button right now. Element Axis is built for people who want to understand what's actually happening in these markets, so you can make your own informed decisions. We don't do predictions, we do preparation. And this week, you're going to need every bit of information you can get because the data coming out over the next few days will either confirm this recovery or send us back toward those lows we saw earlier this month. Let me walk you through what actually happened and why it matters. Monday's trading session saw precious metals sell off across the board. Gold fell 1.2% to around $4,821 per ounce. Gold futures barely held above $5,000. Spot platinum dropped 1%. But silver took the biggest hit, tumbling nearly 3% in some reports to around $75.45 per ounce. Now, if you were watching on Friday, you saw the complete opposite. Silver jumped almost 3% after soft inflation data came out of the United States. The Consumer Price Index showed headline inflation declining and core inflation coming in right where analysts expected. That data reinforced the idea that the Federal Reserve has room to cut interest rates later this year. And that sent precious metals higher because lower rates reduce the opportunity cost of holding assets that don't pay interest. So Friday, we rallied hard on good news. Monday, we gave back a chunk of that gain. The net result is we're still higher than where we were before Friday. But the whipsaw action tells you something important. This market doesn't know which direction it wants to go. It's reacting to every data point, every headline, every shift in sentiment. And that volatility is only going to intensify this week. Here's why this week is absolutely critical. Wednesday brings the release of the Federal Reserve's meeting minutes from January. These aren't just boring bureaucratic documents. They give us a window into what Fed officials were actually thinking, what concerns they raised, how they're viewing inflation and economic growth, and most importantly, what they're planning to do with interest rates. Remember, the market is currently pricing in rate cuts starting as early as June. That's just a few months away. If those minutes show the Fed is more concerned about inflation than expected, if they signal they want to wait longer before cutting rates, that expectation changes fast, and precious metals will react. Later this week, we also get the PCE price index data. That's the Personal Consumption Expenditures Index, and it's the Fed's preferred measure of inflation. A lot of people focus on CPI, but the Fed actually uses PCE to make policy decisions. If that number comes in hot, if inflation is stickier than people think, it pushes back the timeline for rate cuts. That's bearish for gold and silver in the short term. If PCE comes in soft and confirms what we saw in the CPI report, that reinforces the idea that rate cuts are coming, and precious metals should catch a bid. We're also getting trade data and industrial production numbers. Those matter because they tell us whether the economy is actually slowing down or if it's still running strong. A strong economy gives the Fed more patience. They can wait on rate cuts. A weakening economy accelerates the timeline. And with all the talk about tariffs and trade policy coming out of Washington right now, the trade data could show us whether those policies are starting to impact the real economy yet. Now, let me give you some context on why Monday's move, while significant, might not be the whole story. Trading volumes were extremely thin. When you don't have normal liquidity in the market, price moves get exaggerated. An order that would barely register on a typical trading day can push prices significantly when there aren't enough buyers or sellers to absorb it. This works in both directions. Just like a sell order pushed prices down Monday, a buy order could push them right back up when normal trading resumes. I'm not dismissing the decline. Direction matters. But the magnitude of Monday's move is distorted by the holiday conditions. And we need to see what happens when full liquidity comes back. Drop a comment right now and let me know where you're watching from. Are you in the United States, Canada, Europe? And more importantly, tell me what you think happens this week. Does silver hold these levels and push back toward $80? Or are we headed back down to test the lows again? I want to hear what the Element Axis community is thinking, because your perspective matters. Let's talk about the elephant in the room. Silver's price action over the past month has been absolutely wild. And if you've been holding through this, you know exactly what I'm talking about. Silver peaked above $120 per ounce in late January. Let that sink in for a second. $120. Then it crashed. It fell all the way to around $64 earlier this month. That's a decline of nearly 47% from peak to trough in a matter of weeks. Now we're sitting around $76, which means we've bounced about 19% off the lows, but we're still down 37% from the highs. This is the kind of volatility that separates traders from investors. If you were using leverage and bought near the top, you probably got wiped out. If you panicked and sold at 64, you missed this bounce. But if you're someone who's been stacking physical silver for the long term, you probably looked at $64 as a gift. You didn't care about the paper price crashing because you understand the bigger picture. What caused this insane volatility? A lot of it came from Chinese traders. Mainland China saw a massive speculative surge in precious metals over the past several weeks. Prices went parabolic. It was a feeding frenzy. But Chinese authorities stepped in to cool things down. They raised margin requirements. They tightened trading rules. They did what regulators do when they see a bubble forming, and the bubble popped hard. The speculative fever broke and prices collapsed. Now here's what makes this week interesting. Chinese markets are closed for Lunar New Year. That means the traders who have been the marginal buyers driving a lot of this price action are completely sidelined. We're trading without them. When those markets reopen next week, we're going to get a major signal about what happens next. Do Chinese traders come back as buyers, or do they continue selling? That answer will tell us a lot about whether this recovery has legs or if we're setting up for another leg down. If you're finding this breakdown helpful, if this is giving you clarity on what's happening and what to watch for, do me a favor and hit that like button. It helps this content reach more people who need to see it, and it tells me you want more of this kind of analysis. Let me give you both sides of this situation because I always believe in presenting the complete picture. First, the bearish case. What could go wrong from here? The Fed minutes on Wednesday could be more hawkish than expected. If officials expressed serious concerns about inflation in January, if they signaled they want to wait longer before cutting rates, the market has to reprice those expectations. That's negative for precious metals. The PCE data could come in hotter than anticipated. Sticky inflation means rate cuts get pushed back. And it strengthens the dollar. A stronger dollar makes gold and silver more expensive for international buyers, which reduces demand. There's also uncertainty around the Fed leadership transition. Jerome Powell's term expires in May, and President Trump has nominated Kevin Warsh to replace him. Warsh is seen as less dovish, more disciplined on the Fed's balance sheet. Markets don't like uncertainty, and until we get clarity on how Warsh will actually run monetary policy, that creates a headwind. Chinese traders could come back and continue selling. The speculative bubble already popped, but maybe it's not done. Maybe when those markets reopen, we see another wave of liquidation. The technical damage is also severe. Silver crashing from 120 to 64 isn't a normal correction. That's a full-blown crash. Technical traders look at those charts and see broken support levels, bearish patterns, momentum pointing down. That creates selling pressure independent of what the fundamentals say. And if geopolitical tensions ease up, some of the safe haven premium that's been supporting precious metals could come out of the price. That's the bearish case. And it's real. These risks exist. But now let me give you the bullish side. Soft inflation data supports the case for rate cuts. Friday's CPI report showed inflation coming down. If PCE confirms that trend, the path to lower rates becomes clearer, and that's bullish for gold and silver. The dollar has been weakening significantly over the past several months. A weaker dollar makes precious metals cheaper for buyers outside the United States. And that supports demand. Central banks around the world are still buying gold at record levels. China, Russia, Poland, Turkey, and many others are accumulating gold for their strategic reserves. This is structural demand that doesn't disappear because of a weekly data release. These central banks aren't trading. They're building long-term positions. Physical demand for silver also remains strong, despite the crash in paper prices. Dealers have reported solid buying on the dips. Premiums for physical metal are still elevated. When paper prices diverge significantly from physical reality, something eventually has to give. The crash also cleared out weak hands. The over-leveraged speculators are gone. What's left are stronger hands, longer-term holders, people with conviction. That creates a more stable base for the next move higher. And fundamentally, nothing has changed for silver. Industrial demand continues growing. Solar panel installations are accelerating. Electric vehicle production is ramping up. Electronics, medical devices, all of these require silver. Supply remains constrained because mines aren't expanding production significantly. Institutional analysts are maintaining their positive long-term outlook on gold. These are people with access to data and resources most of us don't have. And they're saying the structural case remains intact. Geopolitical tensions are still elevated. Trade disputes are ongoing. Global supply chains remain fragile. These are all reasons to own hard assets as a form of insurance. So which side is right? The truth is, both cases have merit. The question is, which set of factors dominates in the short term? And that's what this week's data will help determine. Let me tell you what I'm watching closely. First, the tone of Wednesday's Fed minutes. Are they hawkish or dovish, patient or eager to cut? The language matters more than you might think. Second, the PCE inflation number. Does it confirm the soft CPI reading? Or does it diverge and show inflation is stickier than we thought? Third, dollar price action. If the dollar keeps weakening, that's a tailwind for precious metals. If it bounces, that's a headwind. Fourth, trading volume when Chinese markets come back online. Are we going to see buyers or sellers? And fifth, silver's technical levels. Can it hold above 75? Can it push back toward 80? Or does it break down toward those $64 lows again? Here are the key levels I'm watching. For silver, 75 is near-term support. Below that, 70 is the next level to watch. 64 was the recent low, and that's the line in the sand. If silver breaks below 64, the technical picture gets very ugly, and we could see significantly more downside. On the upside, 80 is the first resistance. Above that, 85 and then 90. If silver can reclaim 90, that would be a strong signal that the worst is over. For gold, 5,000 is the psychological level. We broke below it on spot prices. Can we reclaim it and hold above 5,000? Above that, watch 5,100 and then 5,200, where we topped recently. Below 5,000, the next support levels are 4,900 and then 4,800. Those are areas where buyers might step in. Share this video with someone who's trying to make sense of these markets right now. We're building a community of people who want to understand rather than just react, and your sharing helps that community grow. Now let me zoom out and talk about the bigger picture because I think this is important. What we've seen over the past month is not normal market behavior. Silver swinging from 120 to 64 to 76 in a few weeks doesn't happen during calm, stable markets. Gold moving hundreds of dollars in short periods tells you something. This kind of volatility only shows up at major inflection points. Either we're transitioning from a bull market to a bear market, or we're seeing the kind of violent shakeout that happens during bull markets before the next leg higher. I lean toward the latter, but I want to be honest with you. Nobody knows for certain. What I do know is that the structural reasons to own precious metals haven't changed. Government debt levels are extreme and rising. Central banks continue printing money. Inflation may be moderating, but it's not defeated. Geopolitical risks remain elevated. The trend toward de-dollarization is real, with central banks diversifying their reserves into gold. These are the reasons this bull market started, and none of them have gone away. What has changed is sentiment. The speculative fever broke. Weak hands got flushed out. Prices corrected violently. This is painful for anyone who bought near the top, but it's actually healthy for a sustainable bull market. Markets need these resets. They need to shake out speculators and remind everyone that prices don't go up in a straight line forever. If you're a long-term holder who understands the thesis, this correction represents opportunity. You can accumulate at better prices. You can strengthen your position. The people who panic sold are the ones who typically regret it when prices eventually make new highs. If you're a trader, this volatility is both opportunity and danger. The opportunity is the big moves. You can make substantial returns if you get the direction right. The danger is getting it wrong or being over-leveraged and getting stopped out on a temporary move against you. Let me ask you something, and I want you to really think about this. Did you buy when silver crashed to 64? Or did you sell in panic? Or did you just watch from the sidelines? Your answer tells you something about your own psychology and your relationship with volatility. Understanding yourself is just as important as understanding the market. Here's my personal take, and I want to be clear, this is just one perspective. I think the worst of the crash is probably behind us. I think 64 was likely the capitulation low where everyone who was going to sell in panic already did. I think we're in a recovery phase now, rebuilding from a stronger base. But I don't think we're going straight back to 120. The recovery will be choppy. There will be tests of support. There will be days like Monday where we give back gains. The path higher won't be smooth or easy. This week's data will either confirm or challenge that view. If the Fed minutes are dovish and PCE comes in soft, I expect silver to continue recovering toward 80 and potentially higher. If the minutes are hawkish and PCE runs hot, I expect we test lower levels again, maybe 70, maybe lower. The data will guide us. 3 key things to remember as we head into this critical week. First, don't overreact to price moves on thin volume. Monday's decline happened with minimal liquidity. Wait for confirmation when normal trading resumes. The real test comes with Wednesday's Fed minutes and this week's PCE data. Those releases will determine if the rate cut narrative holds or shifts. Second, understand that silver's volatility from 120 to 64 to 76 represents a major inflection point. The speculative fever driven by Chinese traders broke when authorities intervened. Weak hands are out. What happens next depends on whether buyers defend these levels or if we see more selling when Chinese markets reopen next week. Third, the long-term case for precious metals remains structurally intact despite short-term volatility. Central banks keep accumulating. Debt levels stay extreme. Rate cuts are still expected, potentially starting in June. Focus on fundamentals, not noise. The unresolved question is this. Paper prices crashed hard, but structural factors haven't changed. Sentiment is damaged, but fundamentals remain supportive. Short-term uncertainty is high, but long-term direction appears intact. This week will give us major clues about which force wins in the near term. Do your own research. Understand the risks. Be responsible for your own decisions. Have a clear plan and know your time frame. Are you trading these swings or investing for the long haul? Those require completely different approaches. If you're over-leveraged, this volatility will destroy you. If you're positioned appropriately with a long-term view, this is just noise on the path forward. Drop a comment and tell me what you think happens this week. Does silver hold 75 and recover toward 80, or do we test lower levels? What's your read on the Fed minutes, hawkish or dovish? What's your expectation for PCE? I want to hear from you because this community is smart and we learn from each other's perspectives. If this analysis helped you understand what's happening and gave you a framework for the week ahead, subscribe to Element Axes and turn on notifications so you don't miss the updates as this situation develops.